I used to mark my market structures the hard way, slow, confusing, and costing me trades, until I found a faster, more mechanical method that changed everything. Let me show you how. If you're starting to understand structure, but still feel stuck when it comes to placing real trades, this is where it all clicks. You'll finally fix the missing half of your strategy, the part that turns smart money structure into trades you can actually take with confidence. No more second guessing, no more late entries. Once you see this, your charts will never look the same again. Click the link in the description to get started. So in front of you right now, we have some price action I've marked out, and we'll go through step by step where I was going wrong when marking out my market structure. And then later on, we'll go through how I've changed it and hopefully how you can go forward changing yours too, becoming a more profitable trader. Now, the way we use our structures is critical when it comes for taking trades because it helps us to identify areas of supply and demand. Now, if you are struggling with your market structure, do drop a comment below, let me know, and hopefully I can do a video that helps you on a subject that you are potentially struggling on right now. So first, let's look at this structure in the market. If we just map it out with a pen, then we'll go through more step by step, where I was getting it wrong, how I was taking losing trades, and then afterwards we'll go through the correct way of doing it. And you're also going to learn briefly the valid high and low. It's going to help you. So if we look at this as a move down the market, we can then look at this as a break to the upside. So we then push up, we make this new high, the market pulls back, a potential new high or low. Now, hopefully you understand, you've probably learned and been taught this across multiple places online, that a trend, a bullish trend is making a higher high, higher low in the market. A bearish trend is making lower lows, lower highs. In a way that is true, but you're going to see how that is going to help you to find more losing trades even. When we see this higher low created, we then see this move up, making a new higher high. So there's our continuation to the upside with the bullish trend. Now at this point, we then see the market shifts back down and in fact breaks this low, making a lower low. So what does that mean? That means a potential lower low can lead to a trend reversal, meaning that we're looking for this new high to hold, for price to pull back to continue to break the previous low, continuation with that bearish trend. What actually happens though is that we break back bullish to the upside and we have another shift in trend. Now we can sometimes find price in the chart does this very often. So let's back all this off and let's go into more depth and more detail on what I was doing wrong. So if we mark it off first from this high, we can see this is our first break to the upside, our break of structure. Let's name this a BOS. I know many of you understand that the BOS is the break of structure. Let's name that a BOS. So that's our first break of structure. Now, if you use supply and demand like I do, once I have that break of structure, this move here becomes an area of demand. And what I'll be looking for after the break of structure is created, we look for that high to create. We have the pullback. We're looking for a pullback into the demand to then continue to run the high. Now you can see on this example, we don't quite get to demand and price continues to run higher. So once we see that, we mark off this high as our next break of structure. Again, let's just mark it out as a BOS. So then we have a continuation with a bullish trend. And again, once we've seen this, understanding that we create a new higher high in the market, we'd have a new demand zone we'd mark. Where again, we'd be looking for price to pull back into the demand for the continuation. I'm just going to mark a level out here at the moment for continuation to run that high. That will where we'll be looking for our trade. But on this occasion, you can see it fails. So the first time we don't quite get to demand, the second time it fails and pushes through the demand. So when we've seen this, then that creates this potential low in the market where we're looking for the pullback to hold below this high into where? Into new area of supply. So understanding your structure here, we've gone that bullish move higher, higher, and then we've created the bearish reversal, which we haven't marked. We'll mark that out. That's our break to the downside. So let's mark it out as a break of structure. So we've gone to a bearish market. We're now looking for this supply to hold to continue to run this low. Now we can obviously see this doesn't happen and we have another losing trade. So let's just back that off and I'll grab this level and we have a new break of structure once again now to the upside. So using this, and we'll just take this one away, we can see now where we had that bullish market, we shifted bearish, expecting a continuation bearish, and it failed and went back bullish. So is this the way you are marking up your structures right now? Just leave a comment and let me know, yes, exactly how I'm marking mine up, or no, I mark them differently, just so I know the way you are doing your structures. Now, this is an incorrect way of doing it for me now, and I'll show you why you could avoid the loss on this buy and a loss on this sell using the structures in this way. And I'm going to go through some different concepts on how it's going to help you to identify the correct breaker structure and how it's going to help you identify the correct areas of supply and demand to be trading from. It's going to help you avoid marking it incorrectly. So let's just back everything off that we've put onto this. Right, okay, so we have a clean chart again. So this is how you should be looking at approaching it. But first, before we do this, let me just go through this one area here, which was also incorrect. If you've marked this off as your breaker structure, it's valid if we see a close through, but we don't get the close through. We only have a wick to the upside. So there's the first mistake I was making. I was using only wicks because I saw a higher high in the market. I was using that as a break of structure, but what you really want to be seeing is a body close candle. So let me just take this level again. We'll put this over here. So where we see this bullish candle closing through this high, that is what you want to be using for a break of structure. You want to see a body candle closing through, not using the wick. Now the wick is going to show you where that liquidity is being created, where they grab liquidity above this high, bringing those buys in on a breakout traders, then pushing the market back lower to look for liquidity. Now where's the liquidity sit? It's going to sit below this low. And that's where the market's going to run towards. So yeah, if you understand this concept, you can actually capture good trades, understanding the liquidity in the market, if you understand what's going on. Now, to start with, this high is not even a valid high, and we'll walk through that exactly why later in this video. But the first thing you need to understand is we're not going to use wicks as our break of structure, only if you see a body candle close. So just want to go through that concept first before we carried on. So the correct way that we would be marking up the charts, let's go through the correct way. This is a valid breaker structure. Why is this a valid breaker structure? Hopefully you've been following along. If you have, just drop that comment down and tell me why it's a valid breaker structure. So hopefully you've done that. Now let's go forward. Once we've seen this breaker structure, we can do what? We can mark out that area of demand again. So that's our area of demand marked out. Now we can already see that we come back into the demand this time and we feel an area of imbalance here as well. The way we understand how we avoid this, one, we only look for valid break structure like I just went through, and two, you need to understand your valid highs and lows in the market. Now understanding a valid high and low means this is a valid low because I saw the previous candle closing below this previous candle's low. So this candle closes below this candle's low, validating this low for me. That's when we see this candle breaking up. That's when we find this low is valid, not until this candle closes up. Now, once this candle closes up, we're looking for the same sequence for a candle to close below the previous candle's low. Does this candle close down? No. Does this candle close down? No. That means this is not a valid high. I would not even drawn a level here in the first place. We'll go through a scenario later if this was a valid high and how you could approach that at the same time. So based on that, we would not use this as a valid high. Price makes this low. You know, the reason it makes this low is we have leftover imbalance here just below it and the demand below. We pull back up, we sweep this high, picking up that liquidity, then the market creates this close down. That gives me now a valid high in the market. So once this candle's closed down, I now have a valid high, which means I have my valid low created here. When we see this candle closing up, breaking this structure, we see this candle closing down, creates my valid low. Once we see this candle closing down, it created my valid high. And again, the next video will go through step by step all of this for bullish, bearish markets and the full strategy of marking up the charts. So if it is confusing, bear with me and continue to watch the next video. When we pull back into this area of demand, okay, this is where you can start looking for your trade. Instead of looking to buy here, okay, when we saw this break, we assume with the break, with the wick, remember we're not even using a wick for a break, we had a losing trade here with the demand, and we had a losing trade here with the supply. Now we wouldn't even be doing that. All you'd be doing is looking for a buy out of this area of demand to target the previous high, which is this valid high created here, where we continue up to make a new BOS in the market. So now you've basically gone from taking 2 losing trades, not marking up your charts correctly with structure, to 1 winning trade. Let me just take this off again, and we'll go forward a different way to help you understand. So let me just make a change. If I was to bring this candle down, forget about this candle's not correct at the moment. Actually, let's just change it as well, so you can see it all looks okay. Let's bring this down. I want to give you a different perspective in the market. So now we have this candle closing down. This now creates a valid high in the market. And we'll be looking for continuation with a new breaker structure to the upside. Where we saw previously the correct way of marking it up, how the candles were, this now becomes a valid high. Why is that a valid high? The reason it's a valid high is because we made that close down. So the market pulls back down, creates this high. As it pulls back, we're looking for entry out of this area here of demand. Now it doesn't do that. We come back up and we only wick through. Now that's not a valid breaker structure. So we wait for price to pull back again, and now it pulls back into the demand. Now you can take a buy based off this demand. We still don't have a new breaker structure. So this is still a valid entry, even if we saw this and this wicked upside. So where's the valid breaker structure? Okay, the valid breaker structure on this move becomes this candle here. This then becomes your new valid breaker structure, and your new area of demand is going to be this move down here. You can see how making one change on the chart, I can show you a different perspective. So now we've gone from this being a valid high, a sweep in the market, and it's not a valid breaker structure. We're still looking to take a buy off this demand, which we get. We then move up and we make a valid break again to the upside, leaving a new demand. Price pulls back into that demand, and then we create a new valid high. So let me show you again. Why is that a valid high here? And why does that run on to create a new BOS in the market? Because we had a valid close down on that candle. It creates a valid swing high. And again, this is a valid low because we had that close down on that candle below this previous candle's low. So this became a valid low. And again, it was probably off that low there for us to mark our area of demand. And now we're seeing price breaking out higher. This closes down. This becomes a valid low, which means this becomes a valid area of demand again. And that's the sequence that you would use over and over in your charts. You would not use a wick through as a valid breaker structure. You need to wait for body candle close. You then also need to validate your high and validate your low to validate where your swing point is going to be for your next breaker structure, for the continuation, and to validate where your areas of demand would be for where you'll be looking to take your trades. So we're going to walk through understanding the applying of this smart money structure technique, and then I'm going to combine 2 time frames so you can see how you can look to take some trades, and we'll go through some trade setups. So keep watching so you don't miss any of that in this video. Now, of course, if you want to take your trading, your structures to higher levels and start capturing trades, like you can see these members inside the pro community, do check out the 90-day profit trading system, and you'll find there's a link below in the description of this video. So we're going to start by going some top-down analysis. We'll do a current movement we have now on price from the monthly down to the 15 minutes, showing you how to mark the chart up. Then later in the video, we'll go through some actual 2 time frames together with the entries, so you can see how you combine 2 time frames with this strategy so you can start taking trades with more confidence in your own trading. So we'll start off on a monthly time frame. Now I'm going to do this quite quickly because hopefully you understood the technique. I've been through some previous videos, so we'll just go through this very quickly and mark it up. So currently we don't have a valid high on a monthly, we're just moving higher. So we look for our previous break of structure. We have a valid low here and we have a valid high here. So at this point, this is a valid high. So this is going to be my last break of structure I can mark off on a monthly time frame. So this would be my break of structure to the upside. My valid low from the breakout is this low here. This is my monthly low. Okay, so if you're using these structures with the way you're marking up your smart money structures, this is your breakout. This is the current low. As price moves higher, I'm going to have an area of potential demand down here that I have on a monthly time frame. But since then, we can see a strong run to the upside. We're going to find a nice trending pattern on a daily time frame probably. So that's my monthly. We go down to a weekly. You'll see how quickly we can do this. So the market pushes up here from this low. We create this high, we have another break of structure here to the upside. We continue up and we have this pullback, and then we have another break of structure just recently. So we now have a new break of structure to the upside. We continue to be bullish with the weekly structure. We have a valid low we can mark here in the market. So this is my weekly low. And we did have, okay, let me go closer into the structure. This is how you can understand how price moves. We did have a valid high created here, but now that has created a new valid break of structure. So we went from this larger range to this smaller range, and now we can actually move this low here in the market. Again, that would give me this current area of demand price could pull back into. So there is my current move on the weekly. You can see the strong bullish move on this trend on the weekly, understanding that we're on that strong move up on the monthly. So we're bullish on the monthly, bullish on the weekly. We go to the daily time frame, and we don't really need this level because we only need the last levels in the market. We don't have a valid high on the weekly. This is our previous breakout. This is our current weekly low. So on a daily time frame now, we can see that our valid break of structure. So we had this high formation. Okay, so we came up to this area. This created a valid high here. We then broke structure to the upside on a daily. This created a valid low. We then broke bearish, okay, on this move to downside on the daily. Let me just mark it off so you can see where we have that shift. So we broke down bearish, and let's mark it off. And then since then, this became a valid high. We then had a new break. So we'll just put this above here for the moment. Our weekly and daily is at the same area at the moment. So we've got the same break of structure. This becomes my valid low on the breakout for a daily low. Now we just closed down, which means I now have a valid high on the daily. So if you're using gold, understanding that this is a daily and a weekly break of structure, the move up, this is our weekly low, this is our current move up on a daily. We have, this is a nice area of demand on a daily time frame. We can see price pulling back too, but we could just pull back. We mark it off. I like to see price pulling back in below the 50%. We also have an area of imbalance here and a potential area of imbalance here towards the lower end of that imbalance. Price could pull back too. But this is more to teach you how we look at our structures and we mark them up. So this is my current move on the daily. We're bullish on the daily, bullish on the weekly, and bullish on the monthly. Now we can drop down to a 4-hour time frame. So looking at the 4-hour time frame, this is our daily low and high. And just mark it off that high. On a 4-hour, we have a push up. We don't have a close down until here. So that made this as a valid high on the 4-hour. We then have a valid break of structure to the upside. And then we have this valid break to the upside. This became a low. You can see how quickly we can just look at the chart and we can mark this out. This is a low, and then we pushed up. This creates a valid high on the 4-hour time frame. Then we have this low basically broken to downside. So now we have a valid break to downside, and this creates a valid high on the break to downside. So this is the first time we've seen price shifting to the downside. So now we have a bearish bias on a 4-hour time frame. And we've also created a valid low, which we can mark off here on our 4-hour low. And we're seeing that pullback phase. We do have a bearish bias. We have an area of supply above, and we also have an area of liquidity sitting above this high, which could be run into the area of supply. But we need to remember as well that we're very bullish on the daily, very bullish on the weekly, but the daily has created a valid high, which indicates to me we could start to see that shift bearish. So you could start to see price want to pull back against that daily move, against that weekly move, and then eventually look for price to want to continue higher if we're going to continue higher. So that is the multiple time frame, okay, at the moment down to the 4-hour time frame. If we go to a 30-minute from this point, where we see the structure break on a 4-hour, we've got this as our 4-hour high. We'll remove this area of supply. We don't need that. When we see price, okay, dropping down from this high, we had a valid low here. Let's just say this is a break to downside. We pull down, we make a valid low, we pull back up. So our trading range is from this high to this low. This then becomes a new breaker structure. This became a valid high. Let me just mark it out here, and a valid low down here on this time frame on the 30-minute. So again, we then have an area of supply here, okay, where we do have on a 4-hour time frame this candlestick, okay, on this point, but we do have liquidity sitting above that high, which could be run above into this previous high up here. But based on this time frame, this is our current area price could come back into and then continue down with that 4-hour time frame. So that's looking at the multiple time frames, so the top-down analysis. That's how quickly I'd mark my charts up using this type of structure. So we've got that bearish bias at the moment on the 30-minute, 15-minute. On a 4-hour time frame, we've shifted bearish, pulling back. Okay, we've created that valid high on the 4-hour and the low. When we look at a daily time frame, okay, we've created that bullish move up. We've now created a valid high. We could start to see a potential pullback. Okay, it's also a run on the weekly. We move to the weekly and see that current run on the weekly. And obviously we look on a monthly, we can see that bullish run on a monthly time frame. So that's how we look at marking up a top-down analysis. Now, what about the use of the 2 time frames and how it can help you to find entries? Let's now just remove everything off the chart. And again, if you want to see how I've marked this up, go back to the beginning of this video, watch it all the way to this point again. It will show you how we do that multiple time frame. So let's go to a daily time frame. We're going to look at a potential 30-minute entry today, potentially. And let's just start. We have a nice run. Let's say here, we have a nice bullish run to the upside here. Now, I know this is in hindsight and we can see it's a bullish run, but the process will be the same way we're doing it as we continue forward with price. But let's just mark off, let's say from here somewhere. And what we're going to look for, we're going to run price from here. Let's just run forward and we get a breakout. So straight away, we can understand this is a valid break of structure. Okay, on a daily time frame. We then create a valid daily high here. And this is how we'll just track price. We have a valid low on the close down is going to be down here because this is our, where do we have a close down? We have a close down here. So this in fact would be a valid low here. So that's our valid low on the daily time frame. So understanding price, we're looking for a pullback. Whenever we're looking for pullback, we're looking below the 50%. So at the moment, this would be a valid area of demand. So are we looking for price to come down to this area to look for potential buy trade? Let's go forward and see if we pull back. Okay, so quickly we've shifted bullish again. We never pull back to area. So if we don't pull back below that 50%, I'm just not interested. So now we have a new break of structure. We'll leave that one there. So again, we've shifted bullish. And we'll put that as a new break of structure. Our new low is going to be created here, and that's created because we see this candle closing below the previous candle's low. And again, the video later will go through more depth how we use this. So now we go forward a candle by candle basis. We're looking for a close down of previous candle's low. Okay, so this is closed below this previous candle low. that means this becomes a new high. And again, we'll do the same thing. We're looking for price to pull back below the 50% area. Okay, so for me on this one, I would have an area of demand here, but I also have an area of imbalance sitting above. So either of these areas I'm willing to look to take any buy trades from, and I'll be looking to target this previous high. Let's go forward. Actually, let's go down to a 4-hour time frame. Okay, so we can see where price is pulling back on a 4-hour time frame. Let's look for a 4-hour structure now. This is our daily low. Now let's look at our 4 hours. So from this high, let's look back. Do we not have any close down? No close down. That doesn't close down. I'm looking for a candle to close below. So this is the first candle that closes below a previous candle's low. That means, okay, this becomes a valid 4-hour low, and this becomes a valid 4-hour high. So exactly the same. And this would be a break of structure on a 4-hour as well. So based on that, we have a 4-hour and a daily in the same place. So I'm still looking for price to pull back to this area. That's because this is my daily area of imbalance. Let's go forward. Candle by candle. Let's go candle by candle. Let's go a bit quicker as we're pushing up. So we could continue higher, and again, we'll have no trade. We won't have anything to trade. Let's see what happens. Looks like we're going to go higher. We're moving sideways. Okay, we'll need to drag this across. And I'll need to go back to the daily just to find out, okay, where that was. You can see we've actually pulled back into this at the moment. So either into this or this, we can start looking for any trades. We know now that price is going to drop in at some point. So we drop in. So now we just quickly look at where we sit. We're below 50%. That means I can start looking for a trade. How do we do that? Well, using multiple time frames, 2 time frames. On the 4-hour, let's change this to a 4-hour breaker structure because it'll make more sense because it's in the same place as the daily. This is our daily. It's also going to be a 4-hour high. So we'll leave that as 4-hour high. We'll leave this as a daily low. We know it's a daily and a 4-hour low. We could push deeper into the demand, which is even better, a full fill, but we've touched the 50% area of that imbalance. If we now go down to a 30-minute, we'll now understand how we read 2 time frames. Let's zoom out. This is our current 4-hour swing move to the upside. This is our pullback on the 4-hour. We've also got the pullback phase we can see here on this move on the 30-minute. We just had a big push to the downside. We do nothing anyway until we get to our ideal entry area. Now we can start looking at price. We have a break of structure here to downside. We have a high here we can mark off. And we have a low here in the market. So that's my current trading range on a 30-minute. So what can happen here? We can have 3 different things can happen. 1, we could see price continue lower, breaking structure, leaving a new high, and then we can look for a shift back above that high for a reversal. And that's your reversal entry area back into new area of demand. Or we could just simply see price reversing this pullback phase, and then we see a reversal and continuation like that. And finally, there's one other way we could see just a wick through this low, sweeping the low, and then we run for the high. And that's something we see very often in areas of imbalances in supply and demand. So at the moment, we have some liquidity sitting below this low. Because we have a low created, price will want to run that liquidity. Whether it's a wick through or close through, at some point we should run this low before we really run higher. Let's go forward. Let's go forward a few candles a bit quicker. Let's see what happens. Are we pull back? We're going back towards the low. No. Okay, so we've come back very close to this low. So what's that now creating? It's building more liquidity below this low. Every time we come close to this low, but we fail to break it, it builds up more liquidity from buyers coming into this market. This is really more about structure now, but you're learning more here in this video. So if you're still here watching right now, do leave a comment below and let me know with one word, I'm watching liquidity. Nobody's going to know what it's about, but you do because you've got to this point in the video. Let's continue forward. Let's go step by step, actually. Let's go coming back again. And again, we've just wicked to that level again. What is that going to do is creating equal lows here. More liquidity below those lows. We now have a ton of liquidity sitting below this area. It's most likely going to have to get run either run and close the downside or just a wick through and a reversal back for the high. That's how we look for these potential setups. Let's just see, kicking forward with a candle. Okay, so we've got some sideways price action. I'm not doing anything at the moment until either I see a close down, a wick through to downside, or a reversal of this high. That's all I'm waiting for. So at the moment, price is pushing back up. Okay, candle by candle. This is the best way to understand what's happening. Again, look, we've got even this low here in the market was created on the way out. What's that going to create? More liquidity. And we've also got this build up of this trend line here to the upside. Let me just show you that again. I'll draw this out. Got this trend line here, okay, building up more liquidity. So even this is showing me now that we're likely to push down here to run all this liquidity. Let's just go forward now and see what actually happens. So I have no clue what's going to happen here. I haven't looked at this yet. Okay, so we've run liquidity. Oh, okay, so we have now on this candle, nice big wick to downside. That shows me that candle, what we was looking for. What I was looking for, a run of liquidity in this trend line, a run of these lows and this low over here. All this liquidity has now been taken by this wick to downside. And what I like to see with this as well, we have a break to the upside, internal break to the upside. This becomes my valid low in the market. So what I've now really got is with that breakout is an area of potential demand here. So again, let's go forward now and see what we do on the next candle. Okay, so we created an area of imbalance. Like we saw in the daily time frame, we created an area of imbalance. So we have this imbalance and this area of potential demand. Now, when we have them so close together, and I'm looking really for price to continue higher now after this run, because I want to see this taking all this liquidity, strong bullish move out. I'm going to look for a buy now. But I'm going to look for a buy just at, okay, the low or the high of that area. Okay, so just below this candle into, so we're expecting price to run below that candle into this area of imbalance. So there's the imbalance. We'll have the entry there. We could look for 50% of the imbalance, okay, or the high. As we've got very small movement there, that's fine for an entry. So I'll just bring this across to here. My first target is going to be this high. Why? Because we're still bearish. But this sweep can very often show me this bullish move that we're at least going to sweep and run that high. We could still run low again from there for this demand. But understanding this build up of liquidity, understanding multiple time frames, we are looking for a bullish run towards this high yet. So what I'm going to expect is looking for this nearly 6R to this high. And then I look to hold for this high, which would be what? Over 11R. So we'll lock this off. And then we'll just see where price goes. Go forward another candle. Okay, so we've been wicked in. It did get to the 50%, so we could have gone for a 50% entry there. Okay, we didn't have to go for the high of the zone. You can see very often they will pull back to that 50%. And let's just go forward again. So yeah, we're definitely heading high. Let's go forward. So right now, I can't do nothing now until we run through this high. So let's just see if we can run for that high or not. So we've just tagged again into that area. And this is using multiple time frames. So let's see what happens. Price is moving sideways and we've run through. So now we'd be risk-free on this trade. We've taken that just under 6R off the trade. I'd be moved to break even and I'll be letting it run for the 4-hour high. That's how we use the 2 time frame approach. So now what we have is a break of structure here. So we can take this off. Let's mark this off as a new break of structure on this time frame. So we've broken to the upside. We can also mark off a new low. In fact, let's use this low down here. This is a new low in the market because where we see this candle closing down, that creates this low. So we just need a valid high to be created. We're looking for that close down. Okay, not yet. Not yet. We could continue up first. Okay, so that closes below that candle's low. That creates a valid high. Let me just zoom in. Okay, so this candle closed down. So that creates that as a high. That's how we do this. Now, again, we've got a smaller structure, a smaller range to trade from. We can look again for where is that 50% lie. So it's here. Do we have anything? We don't have anything there. So let's drop down to 15 minutes and see if there's anything lower. Okay, so we do have an area here. So we have a nice looking area of demand. So I'd look for an entry off this demand all day long because it's a good solid entry. Why? Because let me see if I can get rid of this now. We don't need this on here. Okay, so get rid of that. We have what we class as that liquidity sitting here. So we have these equal lows. That creates for me some liquidity in the market. So I'm expecting price to at least want to run this low into the imbalance above. And again, we could see price just running to the imbalance and then shooting away. But let's just set this one up as a buy. Let's go off this area. Stop just below the low. Again, where is our low? Our low sits here. And then we would target the high. I'm not going to look for anything more than that because we're already in this long-term trade. This is 4 trades as we continue to move higher with the structure. So we're bullish on that structure. That would give me, if we get to here, just under 5R again. So let's just bring this across a bit and let's see if we get any entry. We might not, we might just see a continuation. Let's just go forward with price. Okay, we did get a pullback. Let's see if we get triggered. We did. We got just triggered there. And again, look, just while we're on the subject of liquidity, let me just draw this out. We created some equal lows, which basically leaves an area of liquidity sitting below. So price had to take that liquidity into the area of demand. And obviously, we filled that area here, okay, of imbalance. Fully filled it. See how that works? And again, you can learn all of this inside that 90-day profit trading system. So if we now look for this to run for this high, that's what I'll be looking for. We could still have a losing trade to see what happens. Okay, a strong push away. Let's see if we hit target. And we do, we hit target. So that one is a winning trade. Let's leave that one locked to see what's happening. So again, now we have a new break of structure from this high. We've broken out. Let's change that to a line. Then we have a new high created here. And you see price pulling back. And you can see actually we're on the wrong time frame. Let's go back to the 30-minute. Okay, so we have a new high created. And this would be my new low in the market. So we have this one. Let's remove that one. So you can see now that we've got basically, let's get rid of this line here. Oh, and another one. Now we have again an area of demand. So we could look for another entry down here. And obviously we have an imbalance here in the market. Now, again, we can look for where price will pull back to. That we have another below 50%, anything in this area. But again, we're just going to go for another buy entry. Let's keep going with this trend and see if we can keep capturing these trades. So this time a bit smaller, 3R. Let's just see what happens. Let's just run this and you can see how this works. Okay, so okay, we got triggered in, but looks like we could run lower and take us out for a stop. Let's see what happens. No, pushing up again. And okay, so this was a losing trade. So you've just seen how, you can have losing trades with this strategy. There is no strategy that's going to give you 100% winning. But at the moment, you're in this trade for 11R to run for this high. This one hit full target, nearly a 5R. This one would have been a losing trade. Okay, so if you're risking 1 or 2%, that's what you've just lost. That one didn't work out. Now what we had here was a break of structure to downside. And we can mark this out as a new high. This becomes a new low here in the market. And let's mark this off. This would be a break of structure here to downside. Let's just see what happens, see if we shift back bullish or not. Okay, so now we have a new break of structure to the upside again. And that's how we follow our structure. Let's just go forward and we're looking for that close down. See, and we get a close down. So now we have a new high. Again, we do the same thing. We have a new area of demand. Yes, we could just come into this imbalance and head up. Let's just continue with what we've been doing. Let's go for another potential buy here. And this is just over 2R. I potentially might not take this. I'd rather see a 3R trade to see what happens. Okay, so we never got to an entry. We actually held off this area. So no trade there. We then broke through again. Okay, we can see we continue to be bullish at this point. A nice breakout. And we have a new zone we can mark off here. Just mark this off. And this would be our low in the market. Because where we see the close down, break of structure, let's see if we get a valid high created. There's a valid high. Again, we're continuing to be buying because we're going with that 4-hour trend, understanding the multiple time frame here, the 2 time frames. Look, there's our swing pullback looking to run for that 4-hour high. This is how we use our multiple time frames. Let's just go for another entry. Let's have it here somewhere. Now this one I would not take based on this information because look, we have only got under 2R. I want to see really at least a 2, even a 3 to those previous highs. I would hold this though for this high now because we're getting close. Let's just see if we get triggered or not. As we're still bullish, we could pull back, we may not. Looks like we're breaking higher. So there was no trade anyway entered on that one. Now, as price continues to move up, okay, we have a break of structure. This is my last valid low. This becomes our break of structure, and we're looking for new valid high. So let's wait for a valid high. We go forward a few candles. Let's see, we continued up. Okay, we now get a valid high here. So again, let's look for where we could look for buy. Well, we have an area down here, but this is just so far down on this bullish trend. I don't think we've come this far. Now, if we look at where our 50% area sits, where does that sit on this move? Okay, so we do have an area of imbalance here, which means we have a nice area of demand on the move up here. So it's more of a rally-based rally area of demand. So this is an area I would be willing to take a buy from, another set and forget entry style. So I take a buy again from this area. The stop would be below the low. Just mark this off. And again, I would run for the daily 4-hour high here because we've not got much space. We've been going up nicely. We can see that we've got this trade still on. So let's just unlock that. This trade potentially looking for that 11R. This one was a winning trade. We had a losing trade. A few times we haven't been triggered. Let's just see if we get any trade here. Let's go forward. Okay, so we've actually spiked for the high. We didn't close it. So that means any pullbacks are still valid, but we could now run lower and take this area out, and we could run even for this area of demand. Let's see what happens. We've held at the moment, went deep in, and we've actually pushed back up for this high. Now we just closed through that high. So based on that information, that's a new break of structure. We did create a new high here as well. So let me just mark this off. This is a new break of structure. And let's use this low. Our valid low is going to be right there. So this is our valid low. Let's see what happens from this point. Okay, so we run up and we took the high. So this trade has worked out as well. Okay, the larger trade also worked out. We took this high here. So we did very well here on these trades. We got nearly a 3R, we got nearly a 5R, and we've got 11R. And this one was obviously a -2. You need to understand your swing structure in the market. By this, I mean, we have the market pushing down. We have a pullback, a continuation bearish, a swing pullback, another continuation bearish. This shows you a bearish market. Okay, so we're in a bearish swinging market to downside. The charts will never look this simple. I'll tell you this from experience. You've probably seen it yourself. They will be choppy all over the place. They never look like this. So don't expect it when you go to the price chart. And that's where a trader is going to learn and develop to become a better trader once you understand this. So once you understand this is your swing structure, the way we're going to use our areas of a break of structure. Remember, a BOS in the market, that means a break of structure. So if we look at this move to downside, we're looking for what we call our trading range. So what we need to do first is find our current low. Well, we can say this is our low in the market. This is where we see price making a pullback and then a continuation lower and a breakthrough. If I just send this line to the back, okay, so we can see where this candle breaks through, and let's make this a thick line, right? So we have price now continue to be bearish. So how do we recognize a valid high and a valid low in a bearish market? Well, first we need to mark off some levels. So once we have a high, how do we find that valid high? To find that valid high, the market comes down. We have this low created here. We create this low here and a higher low to the right and a higher low to the left. Pivots just show me where we have a higher low to the left, higher low to the right, gives me a pivot low. If we have a lower high to the left, a lower high to the right, gives me a pivot high in the market. Very simple to understand your pivots. But once we see price pushing away to the upside, and then we see the continuation down, once we have a valid break of structure, and if you're not sure on the valid break of structure, watch the video after this video. It goes through to teach you the valid break of structure. Once we have this, we can identify our valid high by looking back. So we look back and we're looking for where we last see a bullish close above the previous candle's high. Now this occurs right here. This candle closes above this previous candle's high. Once we have that identified, this gives us validation for a high in a downwards market. And what we'd mark off is this high because it's created the highest point. So this closing above is your validation once you've seen the break to the downside, and you mark it off the highest point. We're not going to mark it off at this candle, we mark it off at this candle here. So once you have your high in the market, what are we looking for next? We're looking for that valid low. Now for valid low, we're looking for the same thing to happen. We just type this out and put this at the bottom. For a valid low, once price breaks out, we're looking for the first time we see price closing above the previous candle's high. And again, this happens on this bullish candle. This closes above this previous candle's high, and that creates a valid low to be marked. Now, the valid low will be marked from the lowest point, again, from this low in the market. So from this high to this low, it gives you your trading range in the market, where you expect for potential pullback continuation. And that's the easiest way to understand in a downtrend how you're going to mark off your highs and low. And again, I want you to understand this fully. Once we see this reversal, this pivot high, once we have this lower high to the left, lower high to the right, that creates the pivot high. Then price continues to fall and we have a new break of structure here. So what we can mark off is a new break of structure. So this becomes a continuation to the downside. Now, once we've got that break of structure, do you remember the process we went through to find this previous day's high? Let's say this is a daily candle. We look back after the break of structure. Where's the previous time we closed above? Well, it's here. This candle, let me mark it out. This candle here closes above the previous candle's high. So let's say it's the daily candles we're looking at. It closes above the previous daily candle's high. And just like before, we're not going to mark it off, okay, from the high of this candle. We're going to mark it off from the highest point. And that creates your new high in the market. So once you understand the sequence where you see price within that trending phase to the downside, you're always looking for a close above the previous candle's high for a high and the previous candle's high for a valid low. That is when you're using it with a downtrending market. Now we will go through to the price charts after we've gone through a bullish trend to show you exactly how this would look on a price chart. But this is where you need to fully understand when you're marking these highs and lows for validation. The validation part is always where we see the close up, okay, for the valid high to be marked. And also for the close up, as we can see here, for the valid low to be marked as well. And the same here, if we saw this move, let me just take this off. If we'd seen this coming down and we're looking to mark out a valid low, as soon as you see this candle closing up, that becomes your valid low. And when you look back, that becomes your valid high. Just like we see here. Okay, if we have another candle here closing up like this, closing above this candle's high, this becomes our low because this is the lowest point. And this becomes our high because that's where we see the previous candle closing above. Now, if you understand this so far, then drop a comment below and say, yes, I understand the bearish market. Okay, how you're marking this up. So the procedure is exactly the same, but we're just looking at the opposite direction. So again, let's mark this out. Understanding your structure, your swing structure. We have a push to the upside, a pullback, a break to the upside, another pullback, and a continuation higher. So with that bullish swing structure to the upside, it's important that you understand your swing structure. So when we see this move to the upside and a pullback, we create a lower high to the left, a lower high to the right. We create that pivot high. So we can mark a level across here, creating a potential level to be broken. So this becomes a valid break of structure when we see the close of this bullish candle. Now, once we get a close of this candle, we can start finding where our low is to be. Now, where we saw the previous candle for a bearish market had to close above the previous candle's high, this time we look for a candle to close below the previous candle's low. So we look back from the breakout point, and this candle, okay, is the first time we see it close below the previous candle's low. This now allows me to mark this out as a low in the market. Okay, so that becomes my low in the market. Now we do the same thing. We're looking for high. We're looking for the first time we see that close below the previous candle's low. Does it close here? No. Do we close here? No. Do we close here? Yes. This candle is validating the high. So until you see this close down, we cannot mark off our high. Now we can mark it off. And again, we're not going to mark it off from that candle that closes down. You're going to mark it off from the highest point in the move. Now, what this gives you is the bullish trading range. And you expect price to pull back into areas here to continue with the market. And that's exactly what happens. Just like we saw that bearish market. So we take this high away, we can now use a new break of structure. This high becomes your new BOS in the market. So just send this to the back. And as we see price coming up, this does not break the structure. So we cannot change our low or highs yet in the market. Once we see the next candle, this bullish candle closing through this level, that's a valid BOS in the market. And what we can do, we can look to mark out our valid low, looking back, okay, for the first time we see that close down. Now, this is the first time we see a candle closing down. This becomes my valid low. It's the lowest point in the market before we see that break of structure. So again, this was a previous high here until we saw that break of structure. So what you'd have to look for again is the market to show me a close down, okay, closing below the previous candle's low. Once we see this, then we can validate the high, and this would become a new high in the market. Very simple, just the opposite we saw of a bearish trend for the bullish trend. So remember, whenever you're marking this out, whenever you're looking at a bullish trend, you're always looking for the bearish close down below the previous candle's low. And when you're doing a bearish trend, you're always looking for the candle to close above the previous candle's high. So that is a much more deep dive into this. I hope now it's giving you much more clarity and less confusion. And we'll go through to some price charts now to actually apply this. And we'll do just a short bit going through how we apply this to a daily price chart so you can see the steps we take when we're marking it up. So here we are on the EURUSD on a daily time frame. What I'm going to do is just go back a bit in time. Okay. In fact, just keep swinging back. And then we're just going to grab a replay mode and just click it off. Okay. I don't care where it is because it doesn't matter. This is a mechanical way of marking up your structures. So we can see this is a bullish trend already. So let's just mark off where we see price pulling back. So let's actually go nice and close to these candles, because the closer we are, the better it's going to be for you to understand the way we just did it. So we're looking at the moment in the bullish market. Can you remember what we were looking at before when it was a bullish market? What did we need to see? Drop it down in the comments and let me know. Hopefully you understand what you should be looking for now in a bullish market to give us a valid high and a valid low. So done that? Great. So let's carry on. So at this point, at this high, what we can identify is this is a valid high. We can mark a level across. And as price pulls back from this high, what creates that valid high is when we see this bearish candle closing down, okay? Closing below this previous candle's low, that validates that high. Now, once we see the close back up, and we just mark it off with an arrow for you, once that candle there closes bullish, now we can mark off a valid low. So let's just mark up a low in the market. Okay, so where would we be the valid low? Well, we look back from this move. The first time we can see it close down, this candle closes below this candle's low, and this one closes below that low, and this is the lowest point after we see the close down. That becomes your valid low in the market. Now, as it comes for an actual valid high, this candle fails to close below that previous candle's low. So we don't have a valid high we can use at the moment. So we just go forward with a candle by candle, so you can see exactly how you mark this up. Again, keep going forward. We do not have a valid high yet created. We still don't have a valid high. Okay, still no valid high. So all this move up will be a lower time frame. Okay, so run on a daily, which means a 4-hour time frame would be a bullish trend to be taking trades with. So again, we continue forward candle by candle, and you can see how long this move has been going for. We still don't have a valid high. What do you see now? Okay, so now we have this candle closing below this previous candle's low. What does that create? It creates your valid high in the market. With a bullish trend, we're looking for the close down. So we can mark this off now as a high in the market. Okay, so hopefully if we don't get to move into a bearish market, we will go over that in a second. So you can see that this breakout validates then a low to be formed. Once we see this candle closing below this previous candle's low, that validates the high. Now, if we look back, we don't have any candles closing below until we get to here, which validates the low in the market. So what we'll do now, let's go forward quicker with the candles, see if we do break bullish again, right? So once we see this candle closing out through this high, that gives us a new break to the upside, and we can look back from here. Where's the last time we see a candle closing below the previous candle's low? Well, this one here. We close down, the lowest point is here. That becomes your new low in the market, and we can remove this and we can place a new break of structure. Okay, very, very simple. And again, let's go forward, we wait, and there we have it. We have a close straight down, validating this is our valid high. If you're tired of second guessing trades or stuck wondering why structure still isn't working, this is your turning point. There's a proven path where smart money structure becomes second nature and consistent profits stop feeling random. That's what Danny found after nearly $300,000 in losses. He didn't just learn structure, he mastered it and rebuilt his confidence from the ground up. If you're ready for that kind of shift, your next step is simple. Click the link in the description to secure your priority pass and start mastering smart money structure today. So once we have this, we want to now really see a bearish reversal so we can go through the bearish markets. Let's just go forward and see if we can get that bearish reversal. So we get a sweep of the high here. Let's see if we can close down. It'll be great if we do, because then we can start looking at that bearish market. So when we're inside a range like this, you can see how long this range went for. And eventually this candlestick here is a break of structure of this low. So now we have the break to downside. How do we validate the high? Well, we look back from this candle breaking down, where before we were looking for the close to the downside, we're looking for the close to the upside. Right where this candle closes down, the previous candle here, let's go closer into that candlestick. We have a close, mark it off above here, okay? So right there, we have a close above. That is the validation of the high. Here we have another one here and another one here, but we don't use this high. We don't use this high. We use the high of this bearish candle that broke the structure. So if I just now go back so we can grab that current high, and then you can see this becomes your new high in the market. So this is now a valid break of structure, okay, to the downside. So we can mark this off as a valid break to the downside. Now we don't have a valid low. What are we looking for a valid low? Again, if you know, drop it down in the comments and let me know, because then at least I know you're watching to this point in the video. Tell me, what are you looking for that valid low? Okay, so you've done that now. Hopefully let's carry on. So we'll continue with the candle by candle approach until we get that valid low. So do we have a valid low? No, we don't. We still don't have one. Do we have one? No. We continue bearish. We still don't have a valid low. Okay, the market's going sideways. We continue to run lower. And what about now? Well, yes, we do, because we have a bullish close above the previous candle's high. So now we can mark off the lowest point, okay, of that move, which gives me now a trading range from this high to this low in the market. And if we just zoom out, we can see where we had that break of structure here, a break of structure here to the upside, and a bearish break to downside. So we now just go forward again and see if we get a continuation to the downside or a reversal. Well, the market's pushed all the way back up to the previous daily high. Now look at how the market has swept this high. Would you have known to have used this high, or would have you been using this high here in the market? And we know we haven't come nowhere near to that high. Just understanding this strategy will help you to trade in line with the markets. So let's go forward a candle by candle and see if we actually close up or we continue to run lower from here. So we've got a bullish close and we do get a bullish push up. So once you see this first wick through, we do nothing. But once we see this candle closing through, now we have, and we can mark it off, a new valid break of structure to the upside. Now for your low again, how do we find that low? Now if you said we're looking for that candle to close below that previous candle's low, then you are correct. So we look back after the breakout, where's the first time we see it? This bearish red candle closes below that previous candle's low. And this becomes your new low. Now, if you're looking and saying, what are these blue and red candles? Do not worry about that at the moment, because you need to get the understanding of market structure correct. If you don't have that correct, then these candlesticks are not going to mean anything or even help you in the market. So forward. Okay, so once you see this candle closing down, we can now mark off a new valid high. It is that simple. What we're looking at here, let me get my drawing tool, is that we have a bullish move, a pullback, a bullish move, a break, bearish, pullback, continuation. Now that's quite easy for you to see and understand here. Looking at this chart, we have a break to the upside, a break to downside, a break to downside. So we've gone from a bullish trend into that bearish trend. That is a reversal in the market. Now, this is easy when the candlesticks look like this. I'm going to tell you now, they never look like this on the chart. You never see them looking this easy to trade with. So don't expect it. What you need to understand now and take away from this video, what I'm going to show you step by step in this video is exactly how to identify your correct swing high, swing lows, and break a structure using this technique. And what it is understanding the candlesticks on the chart. This is our first low we see in the market. We see the push away. What's going to indicate a potential pullback and a swing high form, which will be this high here, is you need to see a bearish candle. Now this can either be a bullish or bearish candle here, closing below of that previous candle. Once you see a body close below this low, this validates the swing high and this becomes a current swing high in the market. Now, if you don't get this on a pullback and you just see wicks, you don't get a valid close, that is not a valid swing high. Let me say that again. If we don't see a valid close below a low with a bearish candle, we don't yet have a valid swing high, and it's just a simple pullback for continuation with that move. Now, a lower time frame, you're most likely going to see a trend, with this being a run on a higher time frame. Now, more of that we can do in future videos, understanding structure with the trends. But this is how you identify a swing high in the market. Now, the opposite is true when we're looking for that swing low. We have a swing low here, but do we know if it's valid yet? Well, the only way we know this swing low is valid is once we see the opposite. We see a close. Again, this can be a bearish or bullish candle. We see a close with a bullish body close above the previous candle high. Again, we must see a body close above the previous candle swing high, okay, to create this swing low. So this high must be closed with a body close. The same as we see here, this then creates a swing low in the market. It's a valid swing low once you see this. Now, obviously, price can go on to break that high, which creates a break of structure. That's a valid break of structure. We then have a valid low in the market. We follow the candlesticks until we see what? Until we see this. We see a valid close back down below this low. That then gives us a valid new swing high in the market. And that gives you your current trading range. That's what it's all about. It's understanding the use of the candlesticks on your chart to identify valid break of structure and a valid trading range. If you don't have a trading range to trade from, how do you know your directional bias? How do you know where you're looking to trade? So that is the simple procedure. Okay, we'll mark it out now correctly on this chart here. Okay, so this is a valid break of structure. Why? Because we see a valid low in the market. So this is a valid low, which is created. Then we have a valid high created here once we see that bearish closing below that low. And then we get this low being our range low breaking to the downside. Okay, so we have a shift in direction. We were bullish and now we've gone bearish. So what do we look for a valid low? We look for what? A bullish close above the previous candle's high. Okay, so this is your valid close up, which creates a new valid low in the market. We can then identify from here, price closes down and we have what? We have a valid close below this candle's wick. That body close identifies a valid swing high. That becomes a new swing high. This becomes a new break of structure. That is the start of your trading range. Your previous range was this high to this low. That was your trading range. There's your pullback, and we just actually happen to have an area of imbalance there. That price comes off and we continue to go lower. The process is simple once you understand it. If you didn't understand any of this, go back, rewind, watch this part of the video beginning over and over until you understand the concept. Once you understand it, when we go through now to a price chart and apply this to a price chart, you'll see exactly the process you need to follow. So we'll quickly recap what we've just been through. To understand a valid swing high, we must see the body closure of a bearish candle below the previous candle's low. And to find a valid swing low, we must see a body closure of a bullish close candle above the previous candle's high. So now you have a good understanding of the basics of understanding this technique with the candlesticks. What we're now going to do, we're going to go over to a Euro-Japanese Yen daily time frame. I'm briefly going to go through how we mark this up and it looks like on an actual price chart. So here we are on a daily time frame. And when you're applying this, we can just start anywhere on the chart. We're actually going to just mark it off here. Okay. Yes, we saw the previous price action, but doesn't really matter when you're applying this technique. We go in closer and we're going to do what we just went through. Okay, apply that area. We look back. Where do we see a previous bullish candle? Okay, a bearish candle closing below a previous low. Does this candle close below that low? No. Does this candle close below that low? No. We keep looking. Does this one close below that candle's low? Yes, it does. That means you can mark this off as a valid low, and we're looking to see where did that break out. Well, we did have, okay, back here, again, this is a valid low where we see a breakdown, and this is a break to downside. This candle here, if I zoom in, we can see it actually closed above this previous candle's high. That meant, let me mark it off, that became a valid swing high. Now, once we see this candle here closing above this high as a break of structure, then we look back for where we see our last low, and this is our valid low. So that's how we look at the reversal point. Now we move higher. We're looking for the close down, okay? That's going to create what? It's going to create our valid swing high. We don't have one here yet. So right now, I can mark this off as a current daily low in the market. We'll get rid of this at the moment. So our last break of structure was, I believe we had a break here, and it was this high. Just double check it. There's our break structure. So we're looking now for what? Okay, remember, we're looking for that bearish close. Now, when we're doing a bullish move, we're using those bearish closes, okay, to find the low and to find the high. When we're doing the bearish move, then we're using the bullish move. So let's just go forward with a candle. So have we closed down below the previous candle's low? No. So we don't mark anything off yet. Again, have we closed? No. Again, we still haven't closed below the previous candle's low. So if price will continue higher from here, it's just showing me a pullback continuation on this time frame, and there's no actual new swing high to be formed. Okay, so again, let's just see what happens. Now we have a valid close here below that low. So now we have a valid swing high in the market for the daily. And that is how we look at this. So because we have this move, this is our new trading range from this high to this low. Yeah, we have an area of demand down here, but this isn't a valid high until we see this candle closing below this previous candle's low. Hopefully it is sinking in. You understand how simple it is reading these candlesticks. We'll go forward again. Okay, we continue to push down. We've gone into, when I've pushed through. So now we have what? We have a new break of structure. So we've broken through this previous low here. Why? Because it's the previous low. We see this candle closing below that low. Now we have a bearish move. This is where we can look at applying the opposite. Now what do we look for? We're looking for the first time we see it close up to give us a new valid low. But what about our current daily high? We look back. This is the last time we see it close above. That creates this as our new daily high. That's our break of structure, our daily high. We continue forward. We're looking for a close up. There's a close up. That creates our new low. So my trading range is now bearish from this high to this low. And we can either look to trade up against that range, or we can look for pullbacks for continuations. It all depends on your higher time frames. Let's continue and see which way we break. Let's go forward. Let me just play that forward instead. Okay, so we're going higher into the areas of supply, and nearly we broke out. I just want to say, if we see a wick through, that's not a break of structure. It's just a sweep in the market of liquidity. Continue. Right, now we've got a valid break of structure there. We don't do anything until we see that candlestick closure. We've broken through that high. That was our previous trading range. Now we've got this breakout. This is a new breakout. We can look first for our current low in the market. Well, if I just go in closer to those candles, let's go right in. Where do we have a close down? Well, from this high, we can see this candle closes down. We then continue to close down, and we even close down this last bearish candle. So that creates our current low in the market from this low. We then break out. What we're looking for, again, we're looking for the first closure down. This is a close below this previous candle's low. So let's just mark this high as a valid trading high, and we can use this as our break of structure there. So there's our break of structure. That's our current trading range. Okay, very, very simple technique. And we do this across multiple time frames. So there is our current swing high to low. That's our current trading range. You're looking for a pullback into these areas of demand, okay, for continuation higher. Let's see what happens. The market pulls back and we start to react off this area of demand, okay, this area of imbalance. If we now see a close back through the high, that's a valid break of structure again. If we go all the way back down, we close down, that's a reversal. So look where we go. Again, we have nothing. Now we have a valid break of structure. So now what we can do, we can take that away and we mark this off as a new break of structure. So this area of demand is where price has bounced from this area of demand. Now, what about our current swing lows? We can mark this off. Well, there's the last time we see a close below a previous candle's low, and that creates this as a swing low. And now to mark the high again, we wait for that close back down. Okay, now we've had a big outside candle. We need to see it close below the low we've got before we can mark it as a high. Now we get a close below this previous candle's low. Now when we're marking it, we're not marking from this high, we're marking from the main high, which becomes this high here. Okay, we're not using this candle at close, we're using the previous candle's highest point. That gives you your trading range, okay, from this low to this high. That's your current trading range. Prices come back into your closest area of imbalance where we have an area of potential demand. So if you're to see a continuation from here, you want to see the market reversing now back to the upside. And you use multiple time frames here to time your entries. And we'll look more on that in future videos when we go through understanding these types of structures. But let's see what happens with price. Okay, let's go fast forward this bit so you can see what happens. We're going sideways and we break through right there. So once we see a break again to the upside, we can mark off what? Our new break of structure. So that's our new break of structure. We look back. Where's the last time we see a bearish close down? Is on this candlestick here. And again, we wouldn't mark it from here because we've got this wick where we see that sweep. We would mark it from this low. Okay, that's your closest low in the market. So that's your valid low. And again, you just continue until you get the bearish close down for your, there you go. There's your bearish close down. For what? For your swing high. Now this would be this move here, and this would be your low. And that is it. That is the way you're going to look to use this simple strategy to help identify your market structures and your trading ranges. Make sure you check out this video popping up next, which will go through how we look and mark up these charts as well each and every week.